I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and today is Wednesday, March 8th.
And we'll be talking about where mortgage rates are today and also peel the curtain back a little bit more on inflation.
Remember, this is for informational purposes only. This is not financial advice. And if you like what we're doing here, be sure to subscribe, comment, and like. And remember, if you put in a comment, we will actually reply to you very quick. A lot of people don't think that we're going to reply. Absolutely. Put a comment. Tell us about your scenario. If you have questions, we're going to get back to you right away.
That's what we wake up hoping to do.
Yes. Okay, so mortgage rates. You want to know where mortgage rates are, but we have to talk about inflation because...
And why? Why do we talk about inflation?
That's right, because where interest rates go will be determined by inflation.
Right, and the mortgage rates are what they're using in order to keep inflation down. It's not exactly mortgage rates, but it's the Fed funds rate that affects mortgage rates that's really trying to get inflation under control.
So yesterday, March 7th, Jerome Powell spoke. He testified, and he does that occasionally throughout the year. And so it's not an official Fed meeting, but what he did say is basically this. I've highlighted it for you on this Reuters article that the Federal Reserve will likely need to raise interest rates more than expected in response to the recent strong data.
Yeah.
Unemployment was high. Our unemployment numbers, we saw strong job growth.
Yep. And we always talked about good news, kind of being bad news and bad news being good. We just have had too much good news. There's not enough bad news out there to tell the feds what they're doing is working. Right
here, the latest economic data have come in stronger than expected. I mean, basically, its strength is bad news.
Yeah.
We don't want to see the strength. And then further on down the article, just this constant tone and constant message that returning to larger rate increases. So remember, these last couple of rates increases have been only quarters, and it will likely, maybe 0.5% on the table.
Yeah. They were talking, the last was, maybe 3 different quarter hikes. Now I think they snuck in, I think there's a little over a 50% chance of a 50% or 50 basis point hike. And that hasn't been talked about in months.
So the next Fed rate meeting will be at the end of March. So we will keep you posted. So definitely be sure to subscribe and keep up to date on that. But again, we're going to be watching that. But right now so Friday, that March 10th, that's the next big data drop for unemployment payrolls.
Yeah. And why are payrolls so important? Like, okay, so how does that affect inflation?
Yeah, I mean, if a lot of people are finding jobs and out there employed, that shows that the economy is strong. Yeah. Employers are hiring.
Yeah, and they're getting paychecks, and those paychecks are going in their bank accounts, and those bank accounts are being used to buy things.
So if people are if unemployment's low, unemployment rate's low, and there's a lot of new jobs, and you'll see expectations are, I accidentally put here this $. This is not a $. This is 210,000 new jobs. But the point, that's the expectations. And so we actually want to see that fewer people are getting jobs, coming on this report. Yeah. Because if we see big drop that maybe 300,000 new jobs were placed for last month, that'll be a problem.
And remember, this is all in context of inflation. Of course, we want people to have jobs. That's why we wake up and do what we do every day. Yeah. But in terms of getting inflation under control, we just need to see the jobs coming down.
Yeah, it's a hard thing because we are rooting for bad news.
Yeah.
And it's for interest rates. We want the mortgage rates to come down, but bad news has to happen.
And just so that we kind of framework this, we want some bad news to get mortgage rates to come down. And after they come down, then let's start sprinkling a bunch of good news over the next, 5, 10, 20 years.
Yeah. And if you've been watching this for a while, we know that we want balance. And things have been so out of whack since COVID and since the stimulus. It's just been very hard to actually have any kind of good balance between, supply and demand.
Yeah. And we always talk about, kind of what we do is like being a farmer. And what a farmer wants is not a downpour of rain and doesn't want a drought. He wants a nice, steady rain. Yeah. And we just hasn't been any steady rain. It's drought and then downpours.
Yes. And then March 14th, that's Tuesday next week, the inflation report for February. It's going to be covering what the inflation for products has been from February 2022 through February 2023. This will be a very, very big and important drop because last month, the inflation report for January was showing 6.2. The month before that was 6.4. We want to see that number hopefully get into the 5s, 5.9, 5.7. That would be good. If we don't see it move much, if we see a 6.1 or 6.2 or even higher, we're going to see rates, the mortgage rates increase.
Now, just to clarify, so the previous 6.4 applied to February.
Sorry, you're right.
6.4 applied to February, and what they're forecasting is 6.2. So if it comes in higher than that, again, that's kind of too much good news. But if it comes in lower than that, then that's a little bit of the bad news, which turns into good news. So we want that to be lower than 6.2.
Yeah, forecast 6.2, want to see lower. Okay, so we look at the 10-year yield chart every now and then, and I think it's just important for everyone to see the perspective, the 10-year yield. This is, Wall Street uses this a lot because it's so important. All the traders are looking at and trading 10-year.
Yeah, now why 10-year, not 20, not 30, why not 3 years? It's just a good, bigger than bite-size metric that they can use that is not super short-term, because who does things super short-term, and who actually does anything for 30 years? They may plan for 30, but things seem to be in that 10-year mark.
Yeah, right. And then so the 30-year fix and the 10-year yield are correlated. Now, you'll notice the 10-year yield's about 3.9, between 3.9 and 3.5, but 3.95. But the point is that's not, of course, where 30-year fixed rates are at. That's where the 10-year is. But what we're looking for is the movement. And it was March 2nd, 2000. So just like 40 days ago, not even like they're less than 40 days. The 10-year, the yield has increased about 19%, and which is just amazing. It's a very fast increase in the rates, and so that has directly affected mortgage rates. We're going to go to that chart right now. So, for example, that 30-year fix today is 6.875. About February 2nd, I think we were posting about 5.9.
Yeah, we maybe squeezed it to 9. Yeah,
5.8. I mean, it may have even been 5.875. It's about a 1% lower on that rate. So anyway, 30-year fix today is 6.875. The 15-year fix we see at 6.55.
Yeah, jumping into FHA, 6.375, and the 30-year VA, 6.375.
And those interest rates are based off of these loan scenarios for conventional FHA and VA loans, and they come with no points.
Yeah. And I had a borrower today call me actually and say, hey, I know that you guys, quote rates with no points, but can I actually get a rate with points? And I said, yes. So though we actually quote them according to this little schedule here without points, we can quote lower rates. Yeah. But if we're just trying to give you an apples to apples comparison, that you need to be looking at the rates that the Mortgage Brothers team can give you versus the competition, and to look and see if there's any points.
We're a 100% mortgage broker. Our interest rates are better than about 90% of banks out there. And so you want to be very careful. If someone's quoting a rate similar to ours, it's likely going to have extra costs.
Yeah. And the other 10% you'd never want to work with.
Oh, yeah.
So,
yeah, waiting for a call back, waiting for service.
Right.
That's what you get with the Mortgage Brothers team. And
or are they still in business anymore?
Right. All right. So if you have any questions, be sure to put them in the comments below or email us. We'll be happy to help you with your loan scenario for a home purchase or refinance.
All right. Thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.